Hello, VetaVA community, VetaVA professionals. I am Hammer coming to you this week with your mortgage market update, your weekly dose of rate reality. What's going on with mortgage rates? What's going on in our markets? Kind of giving you guys some insight. If you're a consumer, if you are looking at buying a home or thinking of refinancing, we're here for you. This is to answer questions and really just clarify the process and take away the mystique of why mortgage rates are what they are, how they move, and which direction we think they're going to go. I'm joined this week with our guest, Jason Turner. Jason, returning guest, welcome. Thank you again for joining us. Please tell everybody a little bit about yourself.
Yeah, sure. I'm a mortgage broker in Maryland, work in DC as well, working in Virginia, and I've been in the mortgage business for about 10 years now and do a ton of VA loans, and I'm happy to be here today.
Well, thank you. It looks like there's not many people on yet, so we'll probably be joined with more as we go along. As you join us, if you do have any questions or comments, please go ahead and post them. We are here for you. If you're here live, let us know. Say hello. Give us a hashtag live. Let us know if you are a consumer. If you've got any questions, especially rate-related questions, we're here for you. And I know many of you do watch on the replay. I know that you can't revolve your life around our cool show here at 12 p.m. Eastern time on Wednesday. So if you're watching on the replay, though, please go ahead and give us a hashtag replay in the comments. Let us know that you are here. Again, ask any questions that you like. Jason will be monitoring this post, as will I. Feel free to tag us or any other VetaVA moderator, and we'll be glad to get to the bottom of what your questions are and answer them for you. So with that said, let's jump into kind of where we were last week and what we were looking at. So last week we were talking about the Fed meeting, Jason, is where we were. And it was really kind of a not knowing where things were going to go. We knew it was going to be reactionary based on what the Fed members had to say, as well as how markets reacted to that news. So let's take a look at kind of what happened and why we're at where we're at. And I'll throw this up on the screen for y'all. So what happened? Well, rates did improve after the Fed meeting, and they actually got to some of the best rates and pricing that I saw last week was on Friday. So for those of you that don't know how it works, mortgage rates can change as many times during the day as the markets change, and they're actually based on what we call mortgage-backed securities. So as the pricing on these securities improves, generally lenders are going to improve mortgage rates, or what we call mortgage rate pricing, which is that rebate, that credit that you can get towards your closing costs from your lender, or the cost to get a lower rate if you need to buy that rate down. And that's kind of how that works. So last week, we did see rates improve after the Fed meeting, really in spite of what the Fed said. And the Fed made it clear that they need to continue to fight inflation. And last week, the big concern was, how will the Fed react to this banking crisis? And notice my air quotes, because I think that it's about as much of a crisis as if I run out of Reese's in my refrigerator, because yeah, I'm disappointed and it's frustrating, but it's far from a crisis. And that's what I feel about our banking situation. I'd call it our banking drama, our banking turmoil, but I wouldn't call it our banking crisis. And the Fed was also very clear that they were more interested in fighting inflation than worrying about the banking sector falling apart, because they didn't think the banking sector would fall apart. So the messaging that the Fed members had last week, and that Fed Chair Jerome Powell had in his press conference, was that they were, the Fed was going to continue to raise interest rates and would hold those rates through the end of 2023. And markets right now ignoring what the Fed is saying. It's kind of like having a child that just thinks they know better. So markets are like a teenager, and the Fed is like, now you listen. You've got to be home by 11 p.m. and get your homework done. And the markets are like, yeah, right, whatever. I'll sneak back out and I'll ignore you and do what I want. And that's kind of where we're at. So VA rates generally were in the high fives last week. And Jason, you mentioned right before we went live that you actually have seen rates that even VA rates that were a little bit better than that.
Yeah. Let's say mid to high fives yesterday.
Which is good, because what we've seen is from last week, we saw some of our best rates towards the end of last week. Monday, Tuesday, today of this week, a little less. Rates are creeping a little bit higher. Not big moves, people. Nothing that you have to really worry about. But if you're getting rate quotes, for VA rates that are in the fives or even in those low sixes, that is not out of the market. But Jason, you think fives are definitely attainable for those that are looking at rate quotes?
Yeah, for sure.
Yeah. So if you're shopping around, make sure that you keep that in mind. And that's what we want to give you that insight for. If you're looking at a conventional loan for any reason and you're not using your VA benefit, conventional rates are in the low to mid sixes and they've crept up a little bit as well, but still much better than where we were about a week ago before that Fed meeting. Rates were generally in the higher sixes for conventional loans, now working their way down a little bit lower. And that's coming down from the sevens that we saw earlier on at the beginning of March. So as far as the forecast, what we think will happen next and where things are going to go from here. Oh, my slides always, whenever I move the mouse, they always move. There we go. So let's see. I think rates are stabilizing in the areas that we see now. So call it for VA rates, that might be in the high fives, low sixes. For conventional rates, it's going to be in the low to mid sixes, maybe a little bit higher on some days. But we're not currently at risk of seeing rates move significantly higher. If you're out there looking at homes, you don't have to worry that if it takes you a few weeks or even a couple of months to get a home, you should not be facing a situation where rates are going to be significantly higher than where we're at right now based on our current views. And we'll talk a little bit deeper about what those are and why I put that little caveat there. But right now, we're unlikely to see rates go much higher while sentiment remains that the Fed is going to be forced to pause their Fed fund rate hikes. And we'll talk a little bit more about that. I'll show you guys a fancy chart in a minute. But as right now, markets think the Fed is going to have to stop raising that Fed funds rate. And that's what's keeping mortgage rates low. And as I say each and every week, what happens is we see mortgage rates react now proactively to what we expect the Fed to be doing later on through the rest of the year, rather than seeing mortgage rates catch up. So that's why we're seeing that. It's unlikely, though, that we're going to see mortgage rates go much lower unless we have some kind of crisis, another crisis on our hands, something similar to what we had with that banking crisis, quote unquote. And maybe if we see some really, really big signs of recession, or if we see the labor market really take a dip next week on Good Friday, those are some things that could be there. So I've done a lot of the talking, Jason. Let's bring you back in and let's talk a little bit about what have you seen in the markets and where do you think most of your buyers are kind of sitting as far as rates go right now?
As far as rates go, kind of like you mentioned, man, like mid fives to high fives for VA loans and FHA loans, and conventional is going to be in the mid sixes for me anyway. I have seen it kind of go down most recently, like you mentioned, with what's going on with the banks and stuff, which has been a nice breath of fresh air for me and a lot of my clients. So, I mean, I just hope it kind of stays that way. I mean, I don't know if it's going to trend down or not. Maybe you can give me some insight about that. But I mean, I'm hoping that is the case.
Yeah. So, well, all right, then let's answer that question. Are rates trending down, or what would have to happen for rates to trend down? So, with that in mind, let me see if my Remarkable will cooperate, and if I can go ahead and draw a little bit. I always like to doodle when I talk like this, and it does actually make it a little bit clearer. Let's see. It is present with screen share. But now it's not connecting. Okay, so we're going to ignore that for now because it's been acting up lately. So anyway, as far as what would happen for rates to move lower, we would need to see that markets are concerned that the Fed would actually have to cut interest rates. So let's bring up that chart that I talked about before, and this will at least give a little bit of a visual to it. So what we watch are what are called Fed futures. This is what the markets are currently pricing. It's kind of like putting the money down on the ponies, going to the track, and everybody puts their money down and they put their money where their mouth is, and they say, okay, we think that this is where the Fed rates are going to be, and Fed futures are a way for them to monetize that. And I won't go too deep into it, but basically this gives us insight into where the markets are. So right now, markets believe at about a 60-40 split. They believe about 60% that rates are going to stay at 4.75. That's the current Fed funds rate. That's your base rate that the Fed sets. It's their policy rate that they use to manipulate the markets to try to fight inflation, to stimulate the economy. And that's going to translate into all of your different loans out there, because you're going to have home equity lines of credit that are tied to the prime rate, which is 3.25 above that 4.75, or what would put you up to about 8% right now. You're going to have credit card rates that are much, much higher than you've seen in the last couple of years. You're going to have car loan rates that are much higher, where we saw 0% or 1-2% car loans. Now you're seeing 5, 6, 7, 8% car loans, or even higher than that. So right now, markets believe that we're going to stay around 4.75, while there's a 40% contingent to believe the Fed is going to raise rates again a month from now at the May meeting. This is May 3rd. But as we look later on through the year and we get into June, and I'm going to move to July, and in July, markets believe that we're going to either be around 4.75 or possibly lower than that to 4.5. And this signals that the markets are currently anticipating a weakness to come. And that means recession. That means slowdown in labor market, slowdown in spending, a slowdown in inflation. And by the time we get through the year, markets believe that by September and November, and we'll go all the way to December here, that this Fed funds rate is going to be at 4.25 or possibly even lower. They look at 4% is a 25% likelihood, maybe a little bit higher at 4.5% is a 25% likelihood. Now, this is much higher than what the Fed themselves believe that Fed funds rate is going to be at. So this is called the dot plot. And this was done on that meeting last week, where all the Fed members are represented by one of these little tiny circles, and they anonymously vote, and they say, okay, this is where I think the Fed rate is going to be by the end of 2023. So by the end of 2023, they're calculating that the rate's going to be at 5% or higher, 5.25, 5.5, maybe even 5.75%. Very, very few Fed members, just a couple, believe that Fed funds rate will be under 5% by the end of 2023. But yet, when we look at what the markets are currently pricing in, markets believe that will be significantly lower than 5%. And, all of them, there's 1% that believe we might be at 5%. So the markets and the Fed are currently at odds. And, basically it's going to be, if the markets, what we saw in February is that the markets shifted to believe what the Fed said. And that caused mortgage rates to go up because markets said, okay, we're resigned to the fact that the Fed is going to raise these rates. Then what happened is we got the banking crisis and everyone went, oh, the Fed broke the economy. They did it. Now they're going to have to stop. And that's why we saw such a big shakeup, and rates dropped about 0.5% over a course of a few days. And we saw a very big move down in rates. So you have to have that external event, that crisis, to kind of drive rates down lower from here as well. So what could that crisis be? It could be more on the banking, maybe another bank failure or concerns about larger banks failing. There's talk that Charles Schwab is under capitalized for it. And again, I could go really deep into educating all of our watchers on, why these banks are set up that way and what this whole asset thing is. But the bottom line is that it's still really not the crisis that people make it out to be. So where else could we maybe see something that could happen? Maybe if the labor market really were to take a drop on Good Friday, that's going to be almost about a week from 7, 8, 9 days. So it's on April 7th. And what's funny is, because it is Good Friday, normally stock market, I think, is actually closed. The bond market's normally is closed on Good Friday, but it's going to be open because the Bureau of Labor Statistics is going to release all the jobs data on that Friday, even though it's Good Friday. So markets are probably going to close early at 2 p.m., but they will be open. But what's going to happen is that opens us up to a lot of traders not being at their desks and a lot of volatility. So, it's concerning because we may see, for that Friday and the following Monday, we may see a lot of whipsawing in mortgage rates. And it's not anything to get too excited or concerned about, but that kind of could happen. But otherwise, other than those events, it's very likely that rates kind of stay where they're at now, maybe creep a little bit higher.
Okay. Very good to know, man. Appreciate it.
What other, I think a lot of things that are also coming to light that we should probably talk about that's very similar to rates is a lot of people are concerned with buying a home now. The factors that go into that are interest rates too high? Should I wait for rates to come down? And then the other thing is, well, I keep hearing on, the media that, house prices are dropping or they're going to drop. And I can't tell you, Jason, how many YouTube videos I've seen where people are like, there's a housing market crash coming, beware. So give us your opinion. What do you think is going to happen with the housing market, and why is now a great time to buy a house?
I mean, the core issue with housing, and I've seen those videos and they drive me crazy, to be honest with you, because inventory is the key issue with all of housing right now and the lack thereof. Okay. There's still not enough houses for people, which means demand is super high and inventory is super low. Therefore, prices are going to increase over time because we have way more people who want to buy houses than there are houses available. It's simple supply and demand. And every time I see one of those posts or comments or videos, I'm just like, you guys just don't get it. This is not 2008. There just aren't houses right now. And anybody who's in the market knows this and can search any website and see that there just aren't enough houses. And because demand is high and there aren't enough houses, values are simply going to increase and continue to increase over time.
Why do you think that there is not enough inventory? Why do you think more people aren't selling their houses right now?
I mean, people are sitting on low rates. A ton of people are refinanced, and they're like, I can't get as much house than I could have, when I bought previously, and I have a low rate, so I'm just going to stay put and stay with my low rate and my low mortgage and be completely content with that. And I get that. That's a perfectly reasonable mindset. And people just aren't incentivized to really move unless they have like a life-changing event. Maybe they're going to retire. Maybe they have to have an increase in home square footage size for kids or whatever the case may be. But if they don't, then people really aren't incentivized if they're in that situation where they're just paying a low mortgage and there's uncertainty in the market. I think that people are just kind of going to sit tight and sit on their equity until they really have to make a move. That's what I think anyway.
Yeah, and I think you're absolutely right with all that. And that's what's very different, like you said, than other markets. The reason we had a crash in 2008 was there was a domino effect that built kind of like a snowball becomes an avalanche, where we had loans that started to go bad, people that couldn't afford payments, and then that was putting more houses on the market. More people were selling, so there was more inventory. As there's more inventory, it caused prices to come down. More people couldn't pay. That led to more foreclosures, which led to what were called short sales, where lenders would just take less money to get rid of the loan, a bad loan, rather than see the house go worse. So that was a situation where we saw a glut of inventory, too much inventory hitting the market. And that's why we saw a true housing crash, or what led to a housing bubble. This time around, like you pointed out, it's the exact opposite. People are in a home, and you basically, when the labor market, if the labor market really gets bad, if we see a lot of layoffs and people are struggling to pay their bills, that's when we would see more inventory, because people have to fall back and sell their house because they're not able to refinance to get to that equity, because they can't show that they can repay the loan, because they've lost their jobs or they've been in that situation. So that's the caveat is if we see a labor market that really were to turn, and right now we know that that's just not the case. The labor market, very strong, not enough people for the jobs that are out there. We would need to see a labor market that, unfortunately, like one of the towns right next door to mine, you'll see this on a very local level. We have a paper mill. It's a mill town, they call it, and there's a paper mill, and they're going to close this paper mill. And that means there's about 1,200 people now that are going to lose their jobs. In many households, it's the husband and the wife both that work at the mill. So you may have households where there's no income coming in now. So what that will do is that'll dramatically change the landscape of that local real estate market. You'll have people that can't afford their mortgage, people that are going to have to relocate and sell. So you're going to see more houses hitting. But this is just a tiny microcosm, one small town in a big state, in a big country. You'll see those kinds of situations, but that's why the labor market is really that foundation for home prices. It's about if people can afford their homes. And so we'll see that. What about waiting for rates to drop? If you have consumers that come to you today and say, Jason, should I wait for rates to get cheaper before I buy a house? How do you answer that question?
I talk about the cost of waiting and not developing equity over time. So you're going to lose equity depending on what your estimated timeline is to retire. The cost of waiting is very real. And if people are waiting to refinance, guess what? So is everybody else. And then we're back into this whole supply and demand conversation again, because if people see rates drop, then people rush back into the market. And now you're in a more competitive situation than you were before, trying to get a house, probably paying more than you would have paid before. And thus the cost of waiting really applies there. So it doesn't make sense in my opinion, to wait for interest rates, because the rate's going to be what it's going to be. But the housing is really what it's all about. Getting the house and leveraging the equity that you're going to have in that house over time is way more important than what your interest rate is, because you can refinance the rate at some point. I don't know when. Nobody does, right. I don't think. But getting into the house is the most important thing, in my opinion.
And for our veterans out there, one of the advantages they have when it comes to that opportunity for refinancing, do you want to just take a minute and tell everybody a little bit about the Earl?
Oh yeah, the Earl's an amazing product. I mean, of course, we came off that COVID boom where we did tons of Earls. So the VA interest rate reduction loan is what we're referring to, and it's a streamlined refinance with no appraisal, no credit qualification, and it's a very low doc process where if interest rates drop more than 0.5%, then the veteran becomes eligible for the refinance, and they have to make 6 payments and wait 210 days since the mortgage was initiated. So if you meet those qualifications, it's a very great way to save money over time if it meets, the certain criteria that people may have. It's not for everybody, and it's certainly not worth paying a bunch of points to do. In my opinion, again, it depends on the scenario, but it's a really great way for veterans, especially, to take advantage of lower rates.
Definitely. And, again, it's not something that's guaranteed, but it certainly is very likely for everybody that they'll see a scenario. In fact, let's talk a little bit about where rates are likely to go and if an Earl would be something that someone is looking at. So over the next 15 days, rates are likely to move up and down. Not anything dramatic. Figure maybe 0.25% up, 0.25% down, within that range. And I know that may sound dramatic to a consumer, but as a mortgage professional, that's not dramatic to us. We're talking where rates move a point one way or the other. That's dramatic. So we're likely to see rates move a little bit up and down. But what we really want to be keeping an eye on, and we'll talk about it more next week on next week's show, is that labor market report that we're going to get on April 7th. Over the next few months, rates are still likely to improve, y'all. I mean, that's what markets are pricing in. That's what the traders are expecting. That's why they're expecting to see that Fed funds rate drop over time. And that's what we're expecting to see with mortgage rates as well. And that, over the longer term, over the rest of 2023, rates are going to improve once we see signs of a coming recession, when we see economic slowdown, when we see labor market weakening, when we see falling inflation, and we have seen disinflation, as it's called. We have seen inflation, getting better and better, just in very small steps. But what happens, there's a big lag between when the Fed made all these moves and when it actually hits the economy. And we're getting to that stage now where the Fed started to do all these rate hikes in March of 2022. And it's been a year, and now we're starting to see those effects really start to hit the economy, and that's likely to happen more and more over the next few months. So, Jason, thanks again for joining us. Is there anything you want to leave everybody with today?
I mean, if I'm in the market right now, I am really looking for a house at a reasonable price that I can get into and not really worry about the rate. But I always caveat that with people have to be comfortable with the payment. If they're okay with the payment, then I encourage everyone to buy, because I just think it's a great long-term financial decision.
Yeah, I absolutely agree. So, well, thanks again for joining us, my friend, and goodbye, everybody. I'm going to go ahead and wrap it up. Remember, though, you can join us next week. Where's my little next week banner? Here it is. You can join us next week, and the same bat time, same bat channel. That is 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And we look forward to talking to you guys next week. Take care, everybody.